Thanks a lot for having me, Joel. We are, just real quick, I'm Dean Wehrli at John Burns Real Estate Consulting. We're kind of a research and consulting firm. We have a national footprint, and half of our company does these publications based on the metro areas, based on regional, and based on national in for sale, apartments, building products. And then my part of the company does custom consulting most of my clients are builders, landowners, developers, occasionally governments, like bond sales or something like that. And I'm in purely real estate, for sale and for rent, all forms of that. So first, I'm going to start with some national trends, and then show some kind of fundamentals, mostly specific to Sacramento. We'll bleed in some data from the other metro areas in Northern California. And then we'll look at what we think is going to happen with respect to sales and pricing and some indicators like that. Again, we'll focus on Sacramento, but I'll have some regional context as well. So let's start with just purely, again, these are going to be national indicators. This is nationwide. We have, as of right now, about 640,000 single-family home sales over the last 12 months. We project it'll be something like that. We are, like as Ryan noted, and this is happening nationally and locally, we are going to see a decrease in home sales, like we've seen. You see, tell me if you can see my cursor, but we had some crazy days here nationally as well as locally in terms of home sales, in that, when anybody with a pulse or maybe even just a very light pulse could get a loan and buy a home, and a lot of them should not have. And then the doldrums, and now we're heading into, I don't know, it's a little less than normal, but we are growing. Our population and household formation in the country is growing at a slower pace than it was in some years past. Our immigration is much, much lower, although it's starting to bounce back very recently, pretty quickly, but it's still below our kind of long-term norm from the last 10 to 20 years or so. So we are going to grow at a little slower pace. So these aren't really dreadful numbers, but they're lower than normal because we see a certain downturn in the market for sure. Price. So this is the BHVI the Burns Home Value Index. Is kind of a Case-Shiller-like metric that looks at same sale year over year. And we do it on a national level. We do it on a regional level. This against the national. We see prices coming in this year at something like 4%. By the way, these all say December. Just think of these as calendar years. Current is going to be a trailing 12-month figure in most of these metrics. I'm not a huge fan of that, but anyway. But we are seeing a pretty significant price decrease. So think of this as kind of your existing home metric, because again, it's the entire housing stock, new plus resale. Obviously, resales nationwide in most markets are going to be the vast majority of those transactions. So we're seeing a double-digit depreciation next year, another hit in 2024. That would be a cumulative 18% hit to home prices nationally over the next 24 months. I saw recently, oh God, what was it? It was like Fortune magazine or something like that. They asked 27 different groups what they thought, national groups like us, what they thought was going to happen to home prices over the next year. And 4 or 5 of those thought in 2023, it'd be positive, which is delusional. That's not going to happen. And it's for sure going to be negative. Frankly, I don't think it'll come in at 4% this year. And they also, I think the vast majority felt that prices were going to come down. Of course, we were dead last. They displayed them by degree of from most positive to most pessimistic, and we were dead last in that grouping. There was it was weirdness there because some people were talking about years, some people started talking about 2 or 3 years, so it's kind of funky, but still, we are, it may not really be 12%, but it's going to be close to that. We'll see. Now, this here is new home price, and I've been bugging them to stop saying appreciation here and say change. That's irritating because we're not going to have appreciation for a little while. It's going to be depreciation. So price change in this calendar year for new homes, specifically just new homes, we think is going to come in at a little less than 2% for calendar 22. Well, again, so by the way, the reason it still says projected there because we don't have full year data yet, and that has been vetted and produced. We're looking at a 15+% dip next year, and again, about a 6% dip in 2024. And by the way, right now, the metro areas that are leading that charge, if that's the right way to say it, in terms of price depreciation are mostly in the Western US. And it's not just California, by the way. It's Boise, it's Salt Lake, it's Phoenix, it's Austin, it's Vegas. All those metro areas have been hit already and are depreciation pretty rapidly. Texas and Florida are hanging on. Their level of appreciation has plunged though, but they're still appreciating. They'll join us soon. Probably not as harsh, but they'll for sure join us. I saw Ryan has some stats on home size. This, by the way, is new home size, so it's a little different. So generally speaking, new homes are much bigger than resales because we always are building bigger for the most part. But this is you see what happens here is that during COVID, it's true that people bought bigger homes, but they were buying bigger homes not within the same market. A lot of those folks were buying bigger homes in outlying markets because of the work from home revolution that came along with COVID. So they are buying bigger homes at lower prices. That's going to reverse. Typically speaking, our home size preferences, if that's the right word, decrease when prices get high or when the economy is slow, something like that. And with mortgage rates the way they are, we expect, I think we're going to see home sizes start to decrease because people need to fit it within their home buying budget, their monthly payment budget. So always be on the lookout for that. Like Ryan said, when you do start to see some bigger homes come on the market, that could be a sign that things are a little firmer, but we'll see. Mortgage rates. I mean, that's everything. Obviously, going from 3.2 to 7.2 or less than 3.2 was just a monumental impact. It happened so fast. It's unprecedented how fast that happened, how big of a change there was. The Fed is supposed to raise mortgage rates interest rates raise 2 more times. I don't know. We'll see. The rhetoric needs to be very, very hawkish, if that does make sense, on mortgage rates because they really want to corral inflation. If you look at year over year, our inflation rate is still pretty high. If you look at the last 6 months, our inflation rate is at their desired 2%. So you could very well argue. I know you still look at year over year, but sometimes year over year measures can be very misleading, and more recent periods are actually give you a better sense of what's happening in the market. Price is clearly doing that right now. If you look at year over year figures on price, we're in better shape than we really are. Really, the last several months, we've been decreasing price. Same thing with inflation. So does the Fed need to be that hawkish? We'll see. But we do think that, you see the green bars at the end. We think that for 2023 calendar year, we'll have an average mortgage rate of about 5.8%. And that's going to dip to low 5s the following years. We think that in fact, Rick Palacios, who Ryan mentioned, is kind of a leader on this, and John Burns. And we think that the Fed wants to keep mortgage rates at about kind of a floor, I should say, of about 5%. They think that the 2.8 and the 3.2 and the 4.0 was hot money and overinflated, especially the housing sector, and they're probably right. So we don't see it going much better than that. I will say this, though. A lot of our clients are builders, national builders, local builders. All of them think that if we can get down to low 5s, they'll be in fine shape. They'll be able to sell homes normally, let's say, for lack of a better term. So hopefully it will come down. And I'll show in a minute, by the way, that those somewhat shrinking mortgage rates, right now we're at 6.2-ish or so. So if we do get down mortgage rates down to about 5.2, as you know, it has a huge impact. So let's look at local areas. And again, so I know these slides, there's a lot of colors here, but just keep in mind, Sacramento is always going to be purple. And I've shown you some regional MSAs, and these are by the MSA. For Sacramento, for instance, is the 4-county metropolitan statistical area. East Bay, San Jose, Stockton is just San Joaquin County, by the way, and Reno is Washoe for the most part. So you can see what, the craziness that happened with the post-COVID, the $5 to $7 trillion of injected into the economy, that we had this tremendous job growth. We're now heading for some significant job losses. We think it's going to be, this is the orange down here, by the way, is San Jose. So that's very representative of Silicon Valley. We think there's going to be some pretty severe job losses there. I wouldn't be surprised actually if it's a little worse than that, to be honest. Tech had cheap money, a grow at all costs, honestly, anachronistic mindset, and overhired because of COVID, thinking that was what was happening in the aftermath of COVID was going to happen forever, which is just nuts. But so there's going to be some significant job losses here. Sacramento, you see, that's actually for a recession, which we think will happen this year. Most folks do. That's actually not bad. So the Sacramento job losses are pretty muted. They're actually pretty manageable from a long-term perspective. So that's not necessarily bad news. Here's growth. I'll skip over this in for time, but just real quick, this is what we the last year of growth of job growth by industry. And look at that, 17.4% in the construction and building job sector. That's going to slow way down. It already has for sure. It'll be reflected as the data are updated, but that's going to slow down quite a bit. Transportation and warehousing will as well. That's another kind of COVID baby, if that makes sense. We always keep an eye on PBS, professional versus professional business services, I should say there, because those and finance tend to be the higher income sectors. So you want to keep an eye on those guys. I'll skip over this, but employment, the importance of this is to show that most job gains down here on this on the bottom half, you can see the percentage change is mostly in fairly modest income categories. We're not, Sacramento has I think it's about an $86,000 median income, but national, that's more roughly in line with national is below California as a whole, certainly well below California's coastal counties. So it's a fairly middle-class kind of income environment in Sacramento, which means these extraordinary price increases we've seen, partly fed by Bay Area, people who have their jobs from the Bay Area, has really priced out a lot of folks. And that's a big reason, obviously, that we are in the situation we're in now. Unemployment, still great, 3.7%. You can see, though, it's starting to tick up on a month-over-month basis. Again, and this is a situation with year-over-year is by far the best gauge, and we're still well below November of 21. So our unemployment rate that's from a historic perspective, this only unfortunately goes back to 20, but we have back to 2001. I'm sorry, no, yeah, we do. Over here, that's a phenomenal rate. So we still have a very tight job market. A lot of people still on the sidelines, maybe retired forever, but that's going to, for at least the near term, keep some upward pressure on incomes, which I think we see right here. So here we are. We see some, pretty solid income growth this year. We think that's going to slow down a little bit here in the next couple of years because we again do see a recession, we do see unemployment ticking up. So, but still, for a mature metro area, that's not a terrible rate to grow at 2.5%, 3%, or even next year at 3.8%. That's not great. I mean, hopefully that'll as inflation comes down and they control inflation, that'll at least be in line with inflation, although we might have more than 2% for a while, we'll see. But if that should at least meet, if not beat inflation, so we'll continue to be a little more, our affordability will be a little better from net income growth. Now let's look at the regional market here with respect to homes and home prices and home sales. This is existing home resale stuff. Again, same kind of color coordination here. You have, and this is price. I apologize. I probably shouldn't keep San Jose on here. I had San Francisco on here. But that's just nuts too, which, by the way, is in free fall right now in every price metric you can think of. And but you see, this real steady growth. Again, it's not as noticeable if we had a better scale here, but including San Jose, which is just nuts. So this is the existing median price. It's over $1.5 million in San Jose. It's over $900,000, almost $1 million in the East Bay, which is Contra Costa and Alameda counties combined. Right now it's about 3% down year over year. Sacramento is one of the first metro areas in the country to go to a negative year over year figure. Since we have I don't have it here, but we have a measure, that BHVI measure I showed nationally just a couple minutes ago. On the local level, Sacramento peaked in April of 2022, and to the current one, which I believe was data through November, it was down about 7.2%. So really, the metro area, by that measure, which again is kind of a Case-Shiller-like metric, is down a little over 7% peak to trough, which is current trough. That's going to keep being a bigger number as we go forward for sure. So we are getting hit here in terms of, did I do that right? Yeah. In terms of home prices, in terms of existing home sales, see Sacramento is kind of the big boy, about 30,000. You see that, so it is, we are at a lower sales level now than we were throughout this kind of, 2014, 15, 16, 17, 18, 19. Let's call them those normal years. We came out and we shrugged off a lot of the REOs by 13 or 14 for the most part. And became more of a normalized markets. We are for sure down from that. We think the volumes are going to get down even further because of those golden handcuffs that everyone is talking about in large part. And of course, because of affordability, which is much, much worse now due mainly to mortgage rates and of course, gargantuan price increases. So we do think volume is going to be a little stifled for a while. We think it's going to pop back up though in 24, 25 a little bit, but to, long-term norm. You see, by the way, some of these other areas, everybody is a little below the long-term norm, except for Reno. Reno, by the way, Reno is, I don't know if anybody cares about Reno here on the call, but it's been hit by, because the California conveyor belt that sent buyers over there, especially, by the way, 55 plus buyers, is slowed way down, of course, as you'd expect. So Reno is actually a little bit struggling here of late. It isn't kind of one of those, it's another Western market that has been slowed a lot. The new home sales, again, this is new home now. You see Sacramento is by far the largest new home market in this Northern California plus Reno area. I don't honestly, just between us, 100 and some people on the call on the presentation here. I think this is going to be a lower number in 2022. Again, that's not full year data yet, unfortunately. So I think that's going to be a little lower than that 63. And again, this is the 4-county MSA, all new home closings. But we see that number coming down pretty markedly next year, flattening the year after, really almost flat the year after that. But so we see a muted new home sales environment here for the next probably 3 years before it starts to recover a little bit. Again, not greatly though out of line. In fact, with the longer term norm, forget these nutty, 2003 and 4 and 5 and 6 years. Those were nonsense. From a much longer term norm, these numbers they're low, but they're not horrific. Sacramento still has those folks moving in from the Bay Area and other parts of coastal California who need to stay. The whole work from home thing, you're going to have, as folks get brought back to the office, and they're trying to do that now, you will see a lot of those folks. You can't do even a hybrid schedule from Boise or Austin or Phoenix, but you can do it from Sacramento into the Bay Area. It's depending on where your job is in the Bay Area, it's rough. So, and you can certainly do it once a week or something like that. Or if you have like a territory, a lot of folks in Sacramento whose job is Bay Area based, it's because they have a larger regional territory and they can live within that territory. In Sacramento, for affordability compared to the Bay is great. So here's closings. That's kind of the same thing. Here's same thing. Now we have pricing. This is new home pricing. Are we really up 5.6%? I'm always really leery of this because it's new home closings, and new home closings take longer to close, generally speaking, than resales do. So it's a little bit more of a lagging indicator than the resale pricing is. So I'm always a little leery of it. Again, in real life, in actual fact, over the last several months, new home pricing has come down markedly. Concessions are way up. All kinds of there've been tremendous price cuts, and it seems like every builder that introduces a new community is really marking the market. In fact, sometimes marking below market to get some sales traction. So in reality, our pricing is coming down in the new home sector markedly, and we think it's going to pretty significantly next year, and then less so the year after that, which is here. So, oops, sorry. So here, let's look at, this is Sacramento. This is new home median price change forecast. Look together right there, but not the other one. We are estimating a 6% net 2022 full calendar year decrease in the new home price. I think it's going to be a couple ticks higher than that. We're estimating about a 14.5% decrease this year. I keep on saying next year, and a pretty muted one in 24. This is actually a little better than a lot of MSAs have. We have Sacramento coming back a little faster. An argument I'm hearing a lot is that, well, if this is worse, then does this get better? I think there's something to that. I would caution that, though, as I don't think this is going to be that much worse. So I don't think this in 23 is going to be that much better. But I think you can see, from thinking of it from here out, what's our net change going to be over the next 2 years? And I think it'll probably be a little less than this implied 17%, but not a tremendous amount less. But what it means in terms of timing is that if your market timing is to enter the market with a new home community this year, you're going to be entering a very price declining environment. It's going to be tough to compete. It's not to say you can't do it, but you're really going to have to be very aggressive on marking your prices to be appropriate for the market. And again, even sometimes under market. There's a couple of builders who are doing that, and they're actually have had a lot of traction. But if your timing is more like, say, second half of 24, you're probably in a pretty neutral environment, a market environment, and it's slow and go, but up from there. We're projecting a 3% net 2025 appreciation rate in the new home sector. So really, your market timing is a lot, and that's not that far off in the future. It takes a long time in California to get something from concept or even from approved map to the market. So if your timing is a little more loose and you can be sometime in 24, preferably later part of 24, I keep going, keep chugging away. This is just give us some national context. This is Sacramento in terms of, again, this is back to the BHBI measure, which is a whole market measure, so mostly resales. You see some of these smoking hot Florida markets and Sunbelt markets in the Southeast are still way up. They will join the party for sure. It's just taking a little longer. And part of that, by the way, you see, these are very high for the most part nationally. From a national perspective, a lot of these are California markets. They're high-priced markets, and they had tremendous run-up during the COVID period. So it's a little bit apples to oranges here, a little bit, but it still means your lower price, more affordable, high growth markets are weathering the storm so far better than a lot of the California markets and the Western. See, a lot of the Western markets are out here. See the Phoenix and your Seattle's, and Seattle's getting hit, by the way, by the tech layoffs as well. I mean, that's where Amazon and that's where Microsoft is. We think every time you see a tech layoff, think, oh, that hurts Silicon Valley, and then Vroom, the car sales techie company that was flying high, has just plummeted its valuation. That's based in Houston, so everybody calm down. And this is also a measure of kind of top to current in terms of housing peak. I mean, look at these Nashville and Dallas and Austin and Denver. That's nuts. They've become way, way less affordable. They have an affordability problem too, believe me, even though their absolute price points are much lower than in California, they still have a comparative affordability crisis there. Some of that was caused, just like Sacramento, by those Bay Area people working for Bay Area companies going over there and buying more expensive houses for, cash or a huge down payment because they just sold their hovel in the Silicon Valley for a fortune. Well, those folks have been impacted by that too. Look at Austin, and Austin is way oversupplied too. So again, those we'll see those folks start to slip down as well. Here's what, okay, now I'm going to just, here's why we think the prices still need to go down an appreciable amount, and that's affordability. So this is our measure of affordability. We think intrinsically, Sacramentans can pay about 34% of their income. There's some other variables that go into this, but think of it kind of like that. And that right now it's about 47%. That's way, way too high. You can see the thing. You can see the metric over here from a longer term perspective. See that? This is the nuttiness of the 3, 4, 5, 6 era. And so clearly, we think this needs to come down. Because of, this is key, this decline you see here toward a more normal long-term affordability level, and this measure is based on the MSA itself, long-term things like income and price and such, we think it's going to come down to a more normal level. But the reason it's going to come down is two things. One, decreasing mortgage rates. I hope we're right about that. But the other one is decreasing home prices. I don't hope we're right about that, but that's that's a critical ingredient in terms of making our obviously our market more affordable. So to get to the kind of affordability level that is long-term sustainable, it's going to take some pain. Supply is, a lot of folks think supply is a magic bullet, and it's not. As Rick said, you can have a price depreciated environment even in a supply depreciation. A supply declining environment. And the reason, of course, is because demand is declining at least as much, if not more, at the same time. You need both of those parts to match up. This is single family permits again, all these data here are Sacramento MSA or whatever the MSA for these Northern California areas. And we do project that permits are going to come down rapidly. A lot of growth here in 2021. So we had a big injection of supply. Somebody talked about Roseville and markets within Sacramento. You have to be really careful though, because Roseville right now is way oversupplied with respect to new homes. So is Folsom, by the way. Natomas is not. Elk Grove is about right. Rancho Cordova is almost, maybe a little oversupplied. But looking at submarket by submarket, and looking at the market as a whole, Sacramento has plenty of supply right now, probably too much. Multifamily permits too for apartments. Obviously, we saw a huge increase in multifamily activity this year, this past year. That's going to slow down, but a lot of more apartment complexes are going to open the next year or two. That's going to keep rental supply high. That's going to slow down the rental market, which has already started. Almost every rental market in the country has slowed down this past quarter, and will continue to do so. We do think the rental markets that are going to be, as a whole, the rental market are going to be more resilient than the for sale market in terms of price, but we're going to see some slowing in rental as well. Here's demand. This is the whole permit of job ratio measure that a lot of folks are familiar with. So because of job growth was so good, 2.6, a normal level, a kind of an equilibrium level of this measure, which is kind of a supply demand measure, is 1.2. 1.2 units of supply to every, units of demand, jobs to every unit of supply, permits. And 2.6, almost 3 last year. But look at the years before, 1918. These are phenomenal numbers. These are great numbers. In fact, Sacramento was pushing some folks. The Bay Area is famous for its EP ratios to be very high, and because they push people out to Tracy and Mountain House and Vacaville and Sacramento and elsewhere. Well, Sacramento even does that and pushes people out to more outlying areas like the Yuba Sutter area, for instance. Those are tremendous. They are very price appreciation kind of levels. Of course, we were coming back from a horrific recession, so it's a little bit of an asterisk to that, but still, these are really good numbers. With job losses next year, which again are fairly mild, we expect that to go negative, of course, but pop right back with some pretty good job growth projection for 2025. 24,000 from a long-term perspective for Sacramento is pretty solid. And again, Sacramento is a mature economy. That's not bad. So the key is resale listings. Look at it. Here's the current month supply, 1.2. It was 0.5 a year ago. Those are both insanely low numbers. A year ago, that's because the demand was so excessive that you put your home on the market. I actually prefer median days on market over average, because average can get really bloated by those properties that stay on a listing forever and ever and ever. Median is usually roughly half, maybe a little more than half of what the average number is. So when it was 13 or 14 months of supply, average days on market, it was 6 or 7 median days on market. It was nuts. There was just no listings. The 1.2, still great, still helping us, still helps sort of bolster or at least sustain the market. But that's because demand has plummeted. Not just the listings have plummeted, but really so has demand. So that's not as great as it looks. It's a nuanced kind of a metric, because it's good to have a limited supply, but the reasons for it are maybe not as good. So because back in the days, it was like Maraca. If you saw something listed, you bought it sight unseen. Not even kidding. We had new home communities in whole submarket. You would put buyers would put their name on the interest list for any new home community in that, say it was Roseville or Manteca, whatever, and they would buy the first home that popped up that they were at the top of the list for, sight unseen, done. That's not true anymore. Now it's kind of, I'm going to wait and see. And of course, one of the dangers of listing your home is that you might not have something to replace it because there's nothing listed. So it's a little bit of a vicious cycle. So let's look at, I want to just walk you through this. Here's the Sacramento MSA. What I did was I wanted to say, okay, let's look at what the typical price for this is a resale home. This is the whole market, so mostly resales. It was $544 in late 2021 at a 3.1% mortgage rate. That was a monthly payment of about $2,400 change. In November 2022, again, latest data we have available, our pricing was a little lower, but of course the interest rate is much higher now. And so that payment was over 30% higher for a little lower priced home. If we are right, by the end of 24, if prices decline to where we think they are, the price would come down, all the way down to a little over 450. If we are right about mortgage rates at about 5.2%, voila, that means a monthly payment that is buying power effectively about the same as it was in these heady days of late 2021 and a similar level of income to qualify. That's so our buying power returns, but again, to get there is going to be semi-brutal. Here is this is investor. I want to show you some stats on investors and flippers. So investors have always been a pretty big part of the market. Here are investor purchases right here on the blue line below since 2005. They've always been a fairly sizable chunk in the market. They peaked up with COVID, as we all know. They're starting to push down a little bit. Unfortunately, we only have through Q3 of 22 for that data, but they are starting to push down a little bit. And I think they're for sure loading this already. Again, this is a little bit dated here, but they're going to go down. And that's important because they are a really, really important part of the overall home sales network and world in Greater Sacramento, and in fact, in most markets too. Flippers are a smaller part of that market. They've actually peaked up a little bit in Q3 of last year. I was a little surprised to see that. I expect those folks to go down too. It's just harder and harder to make that deal pencil as a flipper, and certainly, selling it in a timely fashion is more and more difficult. Frankly, I'm surprised they're as high as they are. Now, just some things about the market that we all know. Tech is something we keep an eye on, even here in Sacramento, certainly in the Bay Area, because they are responsible for a lot of their jobs, because we did have a major influx of folks working from home in Sacramento. That's gone. There aren't any sort of new buyers like that. But Sacramento was always augmented pretty significantly by folks with jobs in the Bay Area. Again, those people, like you're a pharmaceutical rep or something like that. Northern California is your region. You're not going to live in the Bay Area, or very often you chose to live here in somewhere in Greater Sacramento because affordability, and there's still more there than some Central Valley city, let's say. So Meta, Amazon, all those companies have, and now Google too, not you, Google, also is announcing layoffs. It's a little bit exaggerated because the media tends to focus on the top line layoffs, and actually as a sector, tech is pretty flat year over year. That's what this article here is about. This article is a little dated, but not that much. It hasn't been that many layoffs. There's been a few here in January though. There's going to be more. Don't get me wrong, I'm not saying tech's not as bad right now, and tech is going to have more layoffs and is going to pull back for sure. But as most of those folks will find jobs, and probably at lower incomes though. But it's not as I know I'm kind of having it both ways, but it's not as bad as the top line headlines indicate it is. Not everybody works for. When Google said they're going to lay off 12,000 people, they meant worldwide, by the way, not Mountain View. So we'll keep an eye on that though. Immigration here is another thing. We aren't, as I said, we aren't growing. In some more inner ring Bay Area places, absent immigration, they have effectively zero growth. So right now they're at negative growth because folks have moved out so quickly to seek lower prices and work from home. But even when that work from home, it's already kind of stopped, as I said, they still have a growth issue because they are not a high. There's very, very, very low natural growth in those core inner ring Bay Area locations. Another thing about cancellations are up in the new home market, especially incentives and price cuts are in. No incentive seems to be especially a magic bullet, but a lot of the feedback we have gotten from builders is that probably the single best incentive is what you'd probably think, which is some kind of a rate buy down. And so they pay for either a whole term rate buy down or a rate buy down the first 2 or 3 years, something like that. We have seen ARMs, the adjustable mortgages, pop up, but since you usually have to qualify at the higher rate, they haven't skyrocketed by any stretch. I think they're 11 or 12% of the market, something like that. So if but you are trying to be creative. We also haven't seen that, here's a car if you buy a home, things like that. Those funky, weird kind of, they're trying to be a little more rational in their incentivizing. And again, it's buy downs that fit the best. All the niches are hit, by the way, because The lower price, more affordable price housing niches are hurt by the fact that their monthly payment is so much higher. But even the sort of move up is like the niche above you is pressing, maybe is pressing down to the price niche below them. And so on because of affordability issues and such. So even the high end part of the market has been hit. It's almost like everybody's hit as hard. Am I almost out of time here, Joel?
Yeah.
Okay. I'll ask my last thing then. Here we go. I wanted to show this real quick. As Ryan said, I've been thinking about this for a long time. Where the market is now, you want to focus on buyer segments and buyer households that quote unquote have to buy, or at least more motivated to buy right now. And that's things like reloads and they have to come back to the office, or they're expanding, or a newly formed household, growing families, shrinking families, they're getting older, all of those. So all those folks a lot of folks do have those golden handcuffs. They're not going anywhere unless they're, they had 2 more kids or they're relocating. But there is still lots of folks out there who are in a situation where they're more motivated to buy, irresponsive of the golden handcuffs, and those are the folks we will be happy focusing on for the next couple of years. And please rate, subscribe, review the podcast, New Home Insights. Sorry, I'm by law forced to say that on every presentation, Joel. So thanks for having me.
Hey, Dean, if that's what keeps you coming, I'm totally okay with it.